When I started picking stocks, I made a lot of mistakes. Most were unforced, just really avoidable stuff that was getting in the way of actually doing well. So I'm hoping this video saves you from repeating the same mistakes. Let's get into it. I stopped buying the most popular stocks in the world on purpose. I still pick individual stocks, I just don't buy them if they're already included in the S&P 500. Here's the problem. Buying one company exposes you to idiosyncratic risk, and that hits even the huge companies. It's basically risk that applies to that specific company. A giant like UNH can drop 50% overnight when something weird happens and sentiment flips. Nobody sees it coming. So if I'm taking on that risk anyway, I want a small or mid cap with a real shot at 10xing. Think about it. A $5 billion company reaching 50 billion is way more likely than a 500 billion one getting to 5 trillion. Bigger just means harder to scale. This is the first thing an investor should think about. How do you structure your portfolio for your personal investing style? Otherwise, you'll create a mess that you have to untangle later. PE ratios do more harm than good. There, I said it. They're not useless, they're just the wrong tool for the companies I'm hunting for. They get completely distorted for early growth companies, especially ones that just turn profitable. Here's a wild example. A newly profitable company can show a PE of over 1,000 and still be cheap, or it can be a total disaster. The number genuinely tells you almost nothing on its own. That's just the weird maths around earnings inflection. So I look at a bunch of other stuff instead. PE only really helps with mature, slow growth companies. And even then, I'd probably reach for ROIC or ROE first. The truth is, there's no single clean ratio that tells you what a company's really worth. I wish there was, because it would save me countless hours of poring over the details. If I could only look at one number before buying a stock, it would be revenue growth. A company is basically a machine that turns revenue into cash. Without growth, the machine still runs, it still pays out, but it can't get any bigger. Efficiency can buy a company time, sure, but growth is the only thing that raises the ceiling. Quick note on inflation. If inflation's running at 4% and your company's growing revenue slower than that, the top line's going backwards in real terms. That doesn't mean the company is dying. Margins and buybacks can still create value, but on revenue alone, you're treading water. Generally speaking, I don't buy anything that's growing under 20% a year. A faster grower gives me way more confidence in holding it. Growth is potential, sitting in the future, and honestly, that's the thing I'm buying. The bet that the market's projection for revenue is too low, that the machine ends up way bigger than people currently think. When buying a stock, gross margin is my first pass filter for an efficient business. Inefficiency can creep in loads of ways, but gross margin is structural. It's baked in. Different industries run different margins, sure, but a high one just makes every dollar of revenue go further. The thing I really like to see is high revenue growth and a high gross margin together. That combo is where the real magic happens. For tech, I want to see a gross margin over 50%, unless there's some genuinely unusual business model that justifies a lower number. I also like to check the margin over time. Is it holding? Climbing? That tells me whether the economics actually scale, or whether there's a problem nobody's flagged yet. For individual stocks, debt-to-equity ratios give an indication of how much creditor risk sits in front of you as a shareholder. Creditors are senior. They get paid first in a liquidation, making you last in line. I also think of debt as sharing my equity with someone else. Why would I do that? There had better be a really good reason, and the business needs cash to survive isn't a very good one. Even when a company's crushing it, debt means a more leveraged bet. Heavier debt means more fragility the second a recession hits or the market shifts. I also like to look at the current and quick ratios, which are a decent quick check on whether a company can even cover what they owe, at least in the short term. I like to see a debt to equity ratio under 0.2. It's not a hard rule, but if they're running leverage, there needs to be a good reason for it. Everyone's obsessed with investing in moats. I think that's kind of a trap, at least for the companies I invest in. This might contradict the advice you've heard elsewhere, but I'm looking for something the market hasn't noticed yet. Before I buy a company, I need to see that there's something unique about it. Not a moat, I mean something no other investment gives me, with real asymmetric upside. Otherwise, I'm just watering down my portfolio into a boring ETF. And what's the point of doing that? Here's where I break from the usual advice. A famous moat is already priced in. Everyone can see it. If it holds, fine, but I already paid for it. If it slips, I'm the one eating the loss. Bad trade either way. That's the opposite of Buffett, right? He wants long-term compounders where the moat is the whole point. Different game to the one I'm playing, since I'm focused on investing in small, high-growth companies. Ultimately, I want the thing that isn't priced in yet. Not a moat, an unrecognized potential. Google, Amazon, and all the greatest investments of the past, they all had this one thing in common: a massive total addressable market with room to expand sideways. Because the maths on growth is brutal. You basically can't hold 20% revenue growth for decades unless you keep pushing into adjacent markets. You run out of room otherwise. That's exactly why most companies eventually settle into slow cash cows. It's still fine as a compounder, but the rapid growth chapter is short. It ends. So I look for companies set up to expand horizontally with a big market to grow into. And ideally, some early sign it's already happening. That's proof management sees the potential and isn't asleep at the wheel. Before investing, I judge a company by its website. Sounds shallow, I know, but it works way better than it should. Once I've run through all the financial numbers and disclosures, I usually end up on the company's site, just poking around. And I'm quietly asking myself a few things while I'm there. Does this actually explain what they do, or am I leaving more confused than when I showed up? Would I care about this if I was a customer? I mean, is there real value here? Do they feel like they're still building something? Still experimenting and pushing at stuff, taking risks? Or are they kind of just coasting on whatever they made years ago? And the marketing, does it feel innovative? Or is it just the same tired templates as everyone else's? Here's the part that makes it actually useful though. A website is a work product. Somebody in management signed off on every bit of it. It's one of the only things the people running the company put their name to that I can just sit and examine from the outside. So when I land on a thoughtful site where it's obvious a real team of people cared, that tells me a lot. Usually it means they hire well, the kind of people who consider details that nobody's forcing them to think about. And good hiring tends to be where everything else quietly comes from. Look, this isn't foolproof or whatever. It's just one of those things I look at, but it's free and it's revealing, and weirdly, almost nobody takes the time to do it. Share prices tell you more than you'd think, especially on longer time frames. Here's how I like to picture things. A company's value is kind of like a pint of beer. The liquid is the settled value, and the froth on top is just speculation. On a chart, that settled value is basically the 200-day moving average, and how far the price floats above or below that line, that's your froth, the sentiment part sitting on top of the actual thing. What I'm hunting for is a good company stuck in negative sentiment, while the business underneath is totally fine. It happens way more than you think. Usually it's a sector rotation or some thematic or macro sell-off just dragging everything down at once. The good stuff gets sold off with the bad. And that's the setup I want. Quality getting dumped for reasons that have nothing to do with the underlying business, just because it's sitting in the wrong basket when everyone decides to sell first and think later. By the time stock information is in a news headline or social media, that knowledge is already priced in. The worst thing you can do is trade off the news. Chasing sentiment is somehow even worse. Price already reflects what's known. It's kind of spooky how predictable the news feels once you know what you're looking at on the chart. The market moves first, the headline shows up after, kind of late to its own party. I see this constantly, price creeping towards some rejection zone, a moving average or whatever, and then boom, some big piece of news drops and flips the whole trend, right at the expected level. So which was it? Did the news move the price, or did the price drift there for its own reasons, and the news just happened to land at the same time? Honestly, I don't know. Makes you wonder. I've got my own theory, I'll keep it to myself. And sometimes look, announcements line up suspiciously well with key dates, option expiry, that kind of thing. You can draw your own conclusion. It's not my place to speculate. The point is, if it's in the news, it's in the price. So don't trade off headlines unless you really understand the risk you're taking. Anyway, there's no way I could fit everything I've learned into one video. But hopefully some of this has made you into a more dangerous investor. That's it for this video. Hit like and subscribe so you don't miss the next one. See you next time.